Everybody, Wednesday, March 11th, and we are on to day two. Maybe I'll stumble on some words. Maybe I won't. Who knows? This is going great. Don't worry about the fact that everything is dark around me. We're still working on a new set here, which is going to be fantastic. And I like it anyway because I was born in darkness. If you don't get that Batman reference, I can't help you. Let's just look. Oh my gosh, look at the size of this thing. Brief. All right, here we go. Welcome. We're going to talk about a couple of things this morning, as we did yesterday. And why change a good thing? It's going great. Who knows? We'll figure it out as we go along. People asking me to shoot a morning piece, and seems like I have a background in that. Let's keep going. All right, here's the rundown for Wednesday, March 11th. Private credit crisis is deepening. If you've been following me in the Money Printer, you know I've been writing about Cliffwater, what's been going on in private credit. This last week was the big warning sign. We had heard from a handful of managers suggesting this could be the canary in the coal mine for private credit. The fact that we are seeing 7% plus redemptions on Cliffwater, $33 billion fund. In addition, Iran laying mines in the Strait of Hormuz. 140 troops have been wounded. Reports last night that the U.S. sank 14 plus mine laying ships. We'll go with that. IEA proposing the largest reserve release in history. CPI will drop this morning. I'm going to be back at about 8:45, 9 o'clock to go through the CPI with members of Money Printer Pro. Hey, I got it right this time. All right, on top of that, we'll talk about the momentum indicator, the reading the signal in a headline-driven market. Our signal is deeply negative, and that's going to kind of go against the fact for a lot of people that the S&P 500 has been squeezing, as we predicted, over the last 2 days. But we are in kind of a dangerous territory with the 100-day moving average for the S&P 500 acting as resistance. And as I said, the CPI, the February inflation data, comes at 8:30, and that's important because that report comes on data before the Iranian war, before all of the energy spikes. So obviously we have to take that news and then try to apply and guess what inflationary pressures will be fueled by the skirmish or war, whatever it is that we're calling it today. Today's calendar and earnings, we have the CPI at 8:30. At 2 o'clock, the monthly federal budget meeting report will come out. And then to be decided, the IEA reserve release decision. They have a decision on whether or not to release up to 400 million barrels of oil. But if one country objects, Oracle reported Tuesday, big beat, 17.2 billion plus 22%, cloud up 44%, and the RPO number absolutely monstrous. So big move here for Oracle, adding 9.5% after a sizable drawdown from that 340 level. Remember, this is where the liquidity peak happened back around the beginning of Q4, and here has been the drawdown on concerns around the ongoing balance sheet worries about Oracle and questions around AI, etc. So as we look at this right now, it's squeezing higher. Thing that I will note for you today is keep a very close eye today on the 3-minute chart for Oracle, and you want to be looking at the 8-minute. That is not helping me with the 20s. I need the 8-minute chart for the simple moving average, which is the green line, and you want to watch that orange line. When that 8-minute line is under that orange line, that means the short-term trend is weaker than the 20-day adjusted trend. So that's about a 60-minute line versus a 24-minute line. And that could suggest that the stock's actually going to be fading instead of moving higher on this news. Campbell's, hey, this has been one of the worst performing stocks of the last couple of months, and it did not get any better after earnings. Remember, we've been talking about the stocks that are on our breakout versus breakdown list. Campbell's has been the purest breakdown stock on that list going back weeks. So here we are back in September. We've gone from 52 down to 23, and it does not look like it's going to be getting any better. But that said, on the education that we provided on Volume weighted average price. This is a stock to look to potentially trade today if it gets oversold, looking for some reversion, some bottom feeding, and possibility of maybe some insider buying on Campbell's as well. And we'll be looking at UiPath. What do you do? Well, it's an automation AI play. This is all about growth and profitability. We will pay attention to PATH as well. All right. Now, since we don't have to talk about pretty lines, we can talk about the big macro stuff and do so with a lot of big smiling on my face, because this has been the story that I have been talking about extensively, since the repo events had started in Q4, since we started to worry about what was happening with Japan, and here we are. Now, the question that I received last week was, hey, is this the modern day mortgage-backed security crisis? As I have said, the loans were the problem in 2008. Private credit loans are not the problem. The problem, really, at the end of the day, is the concept of liquidity. And what we're effectively meaning by that is not the way that I measured it in the video that I shot yesterday, talking about refinancing liquidity. I'm speaking about the ability to access cash now. And this is the problem. People are showing up, they're asking for their money back, and it's just not there. What happens with these private credit funds is they are effectively borrowing short to lend long. So that means that can be what is known as a liquidity mismatch. And as a result of that, they don't have the cash on hand in order to meet the redemption requests of the investors. These are known as semi-liquid funds, which means they are investors are able to pull their money out on what is known as a redemption window every couple of every quarter. So Cliffwater, 7.7% plus redemption requests, deciding if they should cap that to make it more difficult for people to pull money out. BlackRock saw a 9.3% request. They capped at 5%, so they're limiting withdrawals. Blackstone, same thing, record 7.9% redemption. And this is not really just about private credit itself. It's just about the need for capital for some people. We are on the backside of the liquidity cycle right now, as I've noted time and time again. We are heading into tax season. So in 4 days, a large number of companies will be taking money out to pay taxes. In addition to that, Americans will take money out from their money market accounts and from their bank accounts to pay taxes on April 15th. This is historically a period of time where money leaves the money market, money leaves the reserve system, and that can impact equity markets as well. So it's very important to keep an eye on this. Interval funds, can cap redemptions. That's how you get this liquidity trap. We talked a little bit about MetLife yesterday. This is the same story, and it's just picking up. On the energy side, we just take a real quick look at what's going on in the oil markets. We're seeing a move higher on WTI crude, Brent crude back above 90. It has been a wild move. And as we've noted, some people through the lens of politics are saying, well, oil prices are crashing. Look, yes, oil prices went up to 120 on Monday morning. The reason for that is pretty simple. The reason is Japan, South Korea, other Asian nations desperately need crude to keep their economy going. So they were basically buying whatever they could get their hands on the short end futures contract on Monday morning. And then once there was a realization that they had an ample supply or they were able to secure it, prices came down, and they came down quickly. But the broader story is not going away. Iran obviously has laid mines in the Strait of Hormuz. I've talked about the fact that insurance rates have gone up from 0.25% to 1% for the vessel for one trip. There have been rumors that some rates have gone as high as 3%, which is just insane. And at some point, what happens is you start to assess whether or not investment even wants to stay there. We've seen what happened with the Red Sea. We saw a 90% drop in traffic after the Houthis started to attack ships coming through the strait. The problem here is that there is no workaround. for the Strait of Hormuz. You can go through the Red Sea or you can go all the way around the Horn of Africa. In this case, the only other option to get oil out of the Gulf states is through pipeline, but there's only about 7 million barrels per day in pipeline capacity, which leaves about 13 million sitting there. And the question is whether or not these countries are going to want to try to take that oil out and try to go through the strait, or they're just going to shut down production for now. And that's kind of what the big question is. So as we assess this and as we look at this, the United States can't do this thing with the Navy where they're going to try to help escort vessels through the strait. But the reality is that's not a long-term sustainable solution. So overall, right now, expectations here, again, we're seeing soldiers being wounded. We're seeing vessel mines being sunk by the U.S. Americans are leaving the Middle East, including Saudi Arabia now. The reality is that the Iranian military is adapting some of the U.S. tactics and strategy. U.S. told Israel that it wasn't happy with the attacks on Iranian energy facilities. GOP lawmakers are worried about rising gas prices and how that impacts the midterm elections. So it's a lot of disarray at the moment. And now the big question is, what comes next? Well, it does seem that the floor for oil is somewhere around $80 per barrel. The cost of moving oil through that strait is significant. And we have to keep an eye on the Asian economies, watching what's happening with the Nikkei, with South Korea's indices. The reality is that 94% of oil coming out of the Gulf ends up in Asia. And if this becomes a persistent problem, it's going to lead to a lot of disruption and a lot of questions about how certain nations are going to be able to continue to power their economies moving forward. Number 3 is the IEA, and this is going to hopefully buy them some time. The International Energy Agency calling for the largest reserve release in history. In 2022, after Russia invaded Ukraine, they released 182 million barrels of oil. Now the proposed release is up to 400 million barrels, which should tell you right away how severe this situation actually is and what it means to not be able to pull oil out of the Gulf, where 20% of daily oil flow moves through the Strait of Hormuz. The reserve release would be proposed during an emergency meeting yesterday. They will vote on this today. It can be delayed if one country objects. Goldman's saying that it offsets 12 days of 15.4 million barrels per day disruption. So it could take some off of oil prices. But the question is, what is the plan moving forward to clear the strait, to ensure that there is plenty of oil? They're not going to build a canal through Oman starting tomorrow. This is a problem. This is going to continue to persist. And this is why oil prices will likely remain volatile in the coming weeks. Pay very close attention to the fact that we have that CPI coming up at 8:30. The consensus is for a 2.4% year-over-year increase. Again, I'm going to do a deep dive into the CPI today for our Money Printer Pro, still getting used to that, Money Printer Pro subscribers. Again, won't capture the oil spike yet, but it will set the baseline on which our expectations moving forward will be. All right, yesterday with the Money Printer Pro video, I talked through about volume weighted average price. Volume weighted average price acting as that magnet, right, for institutional flows. And if we look at TradingView, which is my preferred platform for this, because again, I was trained on this, I'm always watching the SPX. The SPX is it's the S&P 500, but what you're really looking at right now is an adapted version of the S&P 500, because there really is no volume on this. So it's measured on options and futures expectations. This blue line is volume weighted average price. These bands here are your deviation bands around that volume weighted average price, 1 minute price. And what I'm always looking for is a dive down into the third or fourth standard deviation of price, and then looking for a reversion back to volume weighted average price, and hopefully a move much, much higher. And what I want to show you is yesterday's move on the SPY, because when the SPX breaks down, I'm looking for an opportunity to trade the SPY, trade the S&P 500, because if we can break above these key levels, there is ample opportunity to profit. So what we saw on the 10th with the SPY was a move off this bottom point here, right? So let's get out of here real quick. There we go. So this is this morning. Let's go back to yesterday. Right? We had this pop. We dropped down to the second standard deviation. We popped above that line. At that point, as I've said, if you are speculating or you're trying to trade on a day like yesterday, you want to buy at the money. So at the money would be the 667 call that expired yesterday. So it's 667 call, break above that line. If you buy that and it chops and it pops back down and falls back under that line, you let it go, you maybe lose 5 to 10%. But look at what happens yesterday. This went from 210 at around 10 o'clock to 380 at 10:30, all the way up to 490 at around 11 o'clock. This is the type of move that you're looking for. And there's a lot of different ways to trade volume weighted average price. We've discussed this multiple times in the past if you followed me. But again, if you're buying at the money, 210 was the value of that 667. It ran through the first standard deviation line all the way up to the second line. Typically, this is where I would take profits. So a 210 turns into a 380, right? Making $1.70 on 210 in about 40 minutes. But it did continue to run. It continued to run to about 490. And then as you got to the end of this rally, which was right up here, we ended up hitting somewhere around 670 before it started to sell off. Now, the key thing about this is you want to make sure that you take profits along the way. If you push through the first standard deviation, your stop out to ensure that you're protecting profits would be back here, which is that first standard deviation line. You do not want to get in the habit of trying to hold things. You want to get in the habit of taking profits. That's the entire purpose of this type of trade. On momentum, we are minus 43 to start the day. And this is one of the key benefits of having access to Money Printer Pro. This is our daily reading for the S&P 500, the Russell, and the NASDAQ. And even though the futures moved higher yesterday, even though the S&P 500 was creeping higher, the underlying belly of the market is still under a lot of pressure. And that's very apparent in the fact that 63% of stocks are under their 50-day moving average, 55% are under their 200-day moving average. And it's just showing us right now what is very problematic about this market is the fact that, yes, it looks like it's going up from time to time. That's that crossover right here, that 20-50 crossover, 20-day moving average against the 50-day moving average. If we step back and look at what this market is doing, it is doing what we have been warning about, which is as you move deeper into this liquidity cycle, we start to fade. And now the process of the channel may very well just be lower highs, lower lows, which means squeezes up along the way, not profit taking like we traditionally see from time to time on the way up, but kind of a slow burn down. So what we have to look for now is constant revisions or pushes back above key moving averages like we saw with the 100-day moving average. And if the market moves to oversold, always watch the hourly, for example. If the hourly gets us down into oversold on relative strength index and money flow index, don't be shocked to see a squeeze. And then we get back up to the top of the channel and it just flushes right back over. This is how markets are behaving in the post-COVID era. More algorithmic trading, more technically driven, more zero-date options, more broker-dealer activity. There's a lot of more focus. I'm not blaming one individual thing. I'm just simply stating there are a lot more factors at play. And it's very important to start to look for patterns and to take profits, not get sucked into a narrative. One of the key things that I said this week, I said it Monday and I said it Tuesday, was that when we have these squeezes, These are what are known as bull traps. That's where you get a 1 or a 2-day squeeze on low volume. People start to get a little bit more optimistic. They hear a big headline, obviously, like we saw with Iran, and now suddenly they're buying from people who are trying to sell, trying to exit. I want to remind you the purpose of a market. It is to sell. So if somebody can buy for 664 and sell for 681, and you're the guy buying it because you're not watching what the technicals are telling you, that is the purpose of the market, and you would be the sucker at that point. The Russell is getting hammered. This is going to be a higher energy issue. This is going to be the jobs report. The Russell looks bad. And I'm going to continue to just advocate and tell you, you have to pay attention to volume weighted average price. You got to pay attention if you're trying to short anything, what side of volume weighted average price you're on. You don't want to be shorting down here with anything. That's where there's a higher probability of a potential reversion. Takes you back to VWAP, and suddenly your short position is stopped out. So if you're going to be shorting in this type of environment, you want to be doing it between these bands at any given time. And if you miss the trade, you miss the trade if it bleeds off, but you want to make sure that you're focusing on your probabilities rather than just trading on pure gut and instinct. That is it for me today. Wow, that went a lot faster than I thought. Fantastic. Well, I want to thank everybody for taking the time to watch me manage your risk. We will see you tomorrow. We'll do this every day. Me and the Money Printer is available on Substack. Don't cost nothing. We follow liquidity, the Fed. Today, our focus is on pipelines versus shipping stocks. Obviously, very timely. If you were a pension manager, what would you be choosing in the next couple of months or years, and how to allocate capital, and what are the ways that you frame that investment decision? I want people to think like money managers in this environment. So the way that we're thinking about this is we've seen these attacks that are happening over in the Strait of Hormuz. If you are a pension manager and you're invested in shipping companies because they were paying a higher premium, how do you now reassess that? And what is the benchmark at which you would assess your investments in shipping against something here in the United States? We also write postcards from the edge of the world. Most recent pick recommendation, I wouldn't even use that word. I just talked about a stock that I own. So scratch what I just said, talking about a bank that I really like and that I own and I gave to my daughter. So obviously we do that every weekend, every Saturday: geopolitics, macro trends, and the stories shaping the global economy. And of course, over at Substack, I don't talk about it much. The insider buying report is available as well. We track corporate insiders that are buying and selling. We release that every morning, sometime between 7 and 8 o'clock. And that is the insider buying report. Look for that on Substack as well. All right, everybody, I hope you have a great Wednesday. If you have any questions, just throw it in the chat or just hit reply. We'll go from there. All right, everybody, take care. Bye-bye.